Whoops. Okay, so here I tallied up all my auto expenses came to $38.96. And my total expenses, this was only for 1 week, was $250.35. So my auto was 15.6%. And my dining out was 10.5, and my utilities were 57. You can read all that. And obviously, your percentages need to all add up to 100%. Right? So you're going to do that math. I don't want to see your spending journals. I don't want to see all the detail. What I want you to do is, you're recording. I want you to figure out the percentage, record the insights as to what you've recorded, any surprises, any warning signs, where would you like to adjust. Please write stream of consciousness, what you glean from reviewing it. And don't worry about this last item because we've already done our cash budgets. Well, no, I'll let that stand. So the last sentence says, we'll use that information from the spending journal to make adjustments to your budget. Let me change that just slightly since we've gone through the cash budget portion already. The last thing I want you to talk about, and this is just one of those things like that attitudes of money assignment where you just kind of write. You know, if it's a paragraph, it's a paragraph. If it's a page, it's a page. Okay, but what I'm looking for is like you're really being honest and reflective. So are there any adjustments to make to your cash budget based on this? Okay, that's what I want you to do with your spending journals. I'm not here on Thursday, you know that. I have no class on Thursday. So I want you to have this piece done for next Tuesday, please. Okay? Again, I don't want your spending journal. All you're doing, and you can put your categorizations, you can put it into Excel and make it a nice pie chart. You can just give me the percentages. I don't care how you do it, but I want you to just have a one-page, no more than one-page reflection. And really that last question is pretty salient, isn't it? Because we spent a lot of time doing our cash budgets. What did your spending journal, how does that kind of tie into what you've done? Okay, so 2/6. And what's today, the 4th, so next Tuesday's the 11th. Okay. We are working now, I believe, on Chapter 3, which is studying what? Taxes, income taxes. And I gave you on last week, did I give you Ella Berry, or who did I give you that we were working on together?
Indigo Smith.
Okay, Indigo Smith. Did I just give you the one tax return? Okay. Okay, so before we turn to this, and what did I ask you to do? I kind of just threw it out there and said, give it a shot. Give it a shot, right? You have 2 W-2s, correct? She had 2 jobs?
No.
No, just one?
And the student loan.
Okay. Way to prep for class, Lisa. 1 W-2, and student loan interest. That's all she had. Okay, great. So we're going to take a look at that, but first I want to go and reinforce something that we were looking at with taxes. Tax formula. Okay. before you look at all the words up here, let me just back up and explain why we're talking about this. Lots of folks, or many people, have some pretty deep-seated misconceptions about how our tax system works, right? It's like, I made $30,000, that's what I pay tax on. Is that a true statement? Why not?
Standard deduction.
Everybody gets a standard deduction. How do you know how much your standard deduction is? The category of what? Anybody remember what that's called? Your filing status. How many filing statuses were there? 5. You can be either single, married filing jointly, so we merge everything, or married filing separately, where we're married as of midnight on 12/31, but we choose to file separate tax returns. Is that generally a good thing?
No, most of the time they want you to file together.
Well, you get to choose.
Yeah.
You have either option as a married person. Is it beneficial for the feds to file separately? Almost never. So who would do it? It's usually like second marriages, not necessarily second, but that's when I see it. They come together and they don't want to really merge their assets, or maybe even have the other person necessarily know what their income stream is. So we file, a lot of us file together for feds and then separately for Montana. Can you file same-sex married filing jointly or married filing separately? You can now for 3 years. Can you file as married without actually having a marriage certificate? Yes, what's that called? Common law, or so it's not. It's statutory, right? You're recognizing your property together, your children together. You merge your assets, you merge your, et cetera, et cetera. Okay, so that's 3. What's the 4th filing status? Head of household, which is somebody that's what? Somebody that's single on the last day of the year, either unmarried or, remember that kind of staff term? An abandoned spouse, you can't find your spouse, and then has a dependent in their home. Right? And then the last status was somebody surviving spouse, lost their, so in the year of death of your spouse, and then the 2 subsequent years, if you have a dependent in your home, you can file surviving spouse.
You know where the common law would have been?
Sure. So I've got a number of clients who marry filing jointly, even though they haven't, ever walked up the aisle and got the proverbial piece of paper. They're recognized by law, and that's not a opt-in, opt-out thing. 1 year we are, and 1 year we're not. I mean, if you're common law marriage, it's because if you're called to task, you share assets, you have children, you share pets, you share property,
There's a certain time though, isn't it? 7 years or?
No, it's 36 months.
Oh.
It's 8 years in Oregon.
Is it? So it's state-based. Maybe somebody look that up real quick, what it is in Montana.
I don't know why it's 7.
So like your partner did get a bunch of debt from the hospital, would they go after you for common law?
So, really great question. Do you mean if your partner died?
Yeah, or like would you in any way be affected by their debt?
Be liable for their debt? I honestly am not going to answer that unequivocally. I think that's more something I would check in with an attorney. So the question is, if I'm in a common law marriage situation and my partner has accrued debt and he or she dies, is that debt going to accrue to me as it would in a regular old marriage? And I mean, I guess I can't imagine why it wouldn't. But I would definitely ask an attorney that question. Did anybody look it up? Let's maybe do that real quick forward. Okay, so what I'm trying to get at, because this is part of doing the tax return, is how do we figure out at the end of the day, everybody's question when you do their tax return is, do I owe money or am I getting money back, right? That's That is based on something called your taxable income. Why did I cross out this personal and dependent exemptions? Did I talk about that? They don't exist anymore after the Tax Cut and Jobs Act that Trump promulgated in December of 2017. Our exemptions went away. We still get them for Montana, but they've gone away for feds. Also, I'm not going to get too deep into tax law, but you should be aware of this. So here I wrote the greater of standard or itemized deductions. And I think that a single person's deduction in 2019 is $12,200. So that means if your W-2 is $9,000, do you even have to file a tax return? Many students still will because they want to, they use their tax return to fill out their FAFSA. Also, if you've gotten any income tax held out of your paychecks, you're going to file a tax return to get that back, right? But if you had if you made $9,000 and you had no taxes taken out and you don't need it for your FAFSA, you don't have any taxable income, you don't need to file a tax return for the feds. And again, you might still file for Montana.
I just want to know your
Oh my goodness. Oh, okay, that's lovely. Hold on. Let's just go deal with that.
all the way down. I was watching.
I know, I was mesmerized too. I was just waiting for a pause.
You learn that too in payroll, like when you're
I love the dance.
She's also the person who knows you have something between your teeth or your zipper still, which is really the person you like. Okay, thanks. Not that else. Okay, so itemized deductions. What are some examples of, first off, who itemizes? Anybody heard of it? Okay, so let's go back. So standard deduction, $12,200 if you're single. Married filing joint, $24,400. Those are pretty big numbers. What kinds of stuff do we itemize? Well, first off, lots and lots and lots of things went away under the Tax Cut and Jobs Act. Here's really what's left. Charity, medical expenses, but only in excess of 10% of your AGI.
Didn't it used to be 7?
7.5.
So now it's 10.
Yep. So if you make $30,000 a year and your AGI is 30 grand, your medical and dental bills have to be over $3,000 before you even get to deduct them.
And then you only get to deduct the amount that's over, right?
You only deduct the amount that's over the 10%.
Yeah. And do premiums?
Great question. Great question. So health premiums, health insurance premiums are includable in that number, but most of us, or not most, many of us pay our health care premiums pre-tax. If you pay something pre-tax, then do you get the double dip benefit of deducting it on your tax return? Of course not.
How do you pay it pre-tax?
Like through an
your
HSA.
employer?
Through an HSA. Or a flex.
So what about for like, I guess there's not really one, for like the school insurance, well, how would that be?
You just pay that out of pocket. That's not pre-tax, is it? You just write, that's just a part of the check you write out. Let's see. Okay, so charity, medical over 10%. The big one that gets most people across the finish line or gets their itemized greater than their standard is mortgage interest. right? Now, did I say your mortgage payment? No, just your mortgage interest. And one more time, how do we calculate interest? Interest equals P,
Principal rate time.
principal times, guys, help me out. So when you make a mortgage payment, right, part of it is going to be attributable to interest and part of it's going to be attributable to principal. And then a portion of it's going to go into something called what? Where you pay your insurance and taxes. Into escrow. You ever heard that term? So really, I'm a little off base here, but not really. When you make a mortgage payment, you pay PITI, principal, interest, taxes, and insurance. PITI, principal, interest, taxes, and insurance. What's deductible? The interest and the taxes. Okay. So you get, what I say, charity, medical over 10%. You get mortgage interest. You really don't get any other interest. You don't get interest on your auto loan or your credit card. You get taxes. One more time? Yeah, you do. Up to 10 grand a year. You get property taxes and you get property taxes and then you get either sales tax or state income tax. So in Montana, all my people deduct state income tax because we don't have a sales tax. But if you lived in Washington State, you would deduct sales tax because you don't have an income tax. You with me? Those are the biggies. There's some other kind of weird things around casualty and living in a federally declared disaster area and blah, blah, blah. But I mean, these are the common ones. But here's the kicker. With the TCJA that Trump passed or promulgated and passed, Tax Cut and Jobs Act of 2017, it changed. Most people no longer itemize for feds. It went away for most people because the standard deductions went up. But I still have to get all the information from my clients because they still itemize for state. They still itemize on their Montana state tax return. I guess they're all like furrowed brows. So it's made it easier for the feds because most people don't itemize anymore. You've got a lot of mortgage interest if you're paying over $24,400 in mortgage interest. Believe me, people's charity doesn't get them over that number, right? Their property taxes don't get them over that number. It's usually mortgage interest. Okay. So adjusted gross income, and let me just define that really quick because I don't think I've done a very good job of that, is gross income minus everything on your Schedule 1. And maybe we could take a peek right now at a Schedule 1 so that we all know what that is. Because you've got one sitting there with Indigo Smith. This is stuff that adds, where am I? This is all the stuff that you add and subtract. Oh, I don't know why this is sideways. It's so weird. This is all the stuff that you add and subtract to just your regular old earnings. right? So like what? What's some stuff I've got to add? You got to pay tax on unemployment comp. You got to pay tax if you've got any rental real estate or a farm. You've got to pay tax if you're self-employed and you have a Schedule C. You've got to pay tax if you get alimony received. So those are all the things that make your adjusted gross income go up. What's all the stuff that makes your adjusted income go down? And I'm not going to explain all of these because, again, you really only use like 3 or 4 over and over and over. But like anybody that's a K through 12 teacher spends money out of his or her pocket to go in the classroom, you get up to $250 right off. We've talked about health savings accounts. If you fund a health savings account on line 12, guess what? Takes your income down. If you, now I'm down on lines 14, 15, and 16, if you're self-employed and you pay self-employment tax, remember that both shares of Social Security? If you pay that, if you pay your own health insurance, if you fund your own pension, you get deductions for that. Those are the biggies. IRA, 19, 20 student loan interest. Based on what I've just told you, what's the difference between all this stuff on a Schedule 1 and itemized deductions? They both reduce the amount you pay tax on, right? So what's different? Does everybody get itemized deductions? No, how come? Because you might not get over, not everybody has those expenses. A, and B, if you have them, you probably, a lot of people aren't going to get over the amount, right? But everybody gets these. So hopefully what your takeaway is right now is this is the stuff that Congress feels is really important because everybody gets to write them off. It doesn't matter whether you itemize or not. If you pay student loan interest, you get to take it off of your, to reduce your taxable income. If you fund an IRA, you get to write it off. Okay, so this is the stuff that's really important from a congressional standpoint. Okay, and then just to quickly pop back here and then we'll take a look at this tax return. So now we come to taxable income. Now where the heck do I go to actually calculate the tax? How do we do that? The W-2 tells you how much tax you had withheld from your paychecks. But that doesn't tell you what your tax liability is, does it? Where do you go to calculate your tax liability? How many people did this? Yeah, you've got to go back to those brackets. And actually this is a little misleading. This is single and married filing joint, isn't it? I just pulled these right off of the IRS website. I don't have all 5 of the filing statuses up there. I've only got 2 of them. We're going to be spending kind of a bit of time with this today to understand the difference between average and marginal tax rates and when is each important in planning. Okay? So can anybody tell me, based on this and what we discussed on Thursday, what kind of tax system we have?
Progressive?
It's a progressive tax system, isn't it? What does that mean? Explain that in your own words.
If your income goes up, the tax rate also goes up.
Right, so your tax rate on all your income?
No, on the next bracket that you fall into, so.
Yes, on the next chunk of income. So I think the example I gave you last week was if you're super high income, a $20 million a year football player, I'm single, I still pay 10% on the first $9,700, just like you or me. Right? Okay. So let's turn to the little simple tax return. Then we're going to lecture a little bit more, and then we're going to take a look at another tax return, and I'm going to give you some homework to do around this. So, I didn't get very far, honestly. So her W-2 gross wages $87,980 for a side gig. But we're gonna do a common kind of tax return that a young single person would do. I've got a little student loan interest, or maybe I've got an education credit, and I've got a W-2. Okay. So now here it's asking me adjustments to income from Schedule 1, line 22. So before I can go any further, what do I have to do? Obviously, I got to go over here. Don't forget to re-enter social up here. If they're married filing jointly, I always put the, you have to mark one's a taxpayer and one's a spouse. I always put the taxpayer's Social Security. Really, just based on our very simple situation, what does she have? She's got student loan interest. Do I use pennies on a tax return? No. And again, you wouldn't know this, but I told you this. I've got some clients that have, like I've got a gal, went to med school. And her student loan interest is like $15,000 a year. How much can you take? $2,500 is the max. And then also I'm going to introduce this, but it's a little above our scope, but just for you to think about, is lots of these deductions phase out when you get higher income. What does that mean? They just start to slowly go away, right? It's not, the government is trying to help you or I with our education costs by giving us an American Opportunity Tax Credit. But it's not trying to help somebody that makes $500,000 a year pay for their kids to go to college. So the credit would phase out for them. Okay, so it starts going away. And all these different credits and deductions phase out at different amounts and different percentages. Nobody memorizes this stuff, believe me. You just need to know where to look it up. What did I give you guys for a resource on Moodle to use to look stuff up? I just gave you the IRS website. And I told you that most of our questions are answered by just going to the instructions for the form you're trying to fill out. Some of it is definitely like, oh my goodness, what the heck are they asking me to do when you get into complex transactions? But most of the simple stuff we're doing, it's like, you can't take more than $2,500. And once you start making whatever, $110,000 a year, you lose a little bit of the ability to take a student loan interest deduction. But she isn't high income. I've already told you the $2,500. So now I'm just going to read the instructions, and it tells me to carry the number down here. When people are like, I don't know what to do, it's like, just read. I don't know what to do either until I just read what it says. And it says here, add all the lines above it.
So it's $7.50 to your house.
Oh, okay, thanks. So I need my glasses on. 5s and 3s look an awful lot alike. Okay, great. So I've gotten my Schedule 1 done. And then also please notice up here in the corner these attachment sequences. Once you've done a 1040, that's the order things go on behind the 1040. We've only got one attachment, so this isn't rocket science. But it does not go like Form 8200s after Form 7900. Okay, it's not that easy. So you got to pay attention to that. Okay, so, and,
You've never used that on the
they're not going to, oh, I didn't leave my phone on the other, well, shoot, I bet you I left my phone upstairs. Okay, that's going to be a little bit of a conundrum. Let me give you something to do while I go find my phone, because A, I've got to find my phone, and B, it's my calculator. Yeah, but I need to figure out pretty quickly where I left mine, either in the bathroom or up in my office. I need to determine that. Let me, just to give you something to do while I go do that, give you the second tax return to look at and just have you do some light math because this person has a couple W-2s. So just to give you something to kind of work on while I'm poking around. And you won't get too terribly far, hopefully. Find it pretty quick. Okay, I hope that I gave too many first two. Everyone got one? Yay, okay. Thanks for your patience. Take a look at the information first before you start on it. Okay, sorry. Regroup. Okay, let's stop on Ella, which we're going to do at some point, and finish Indigo. Okay, so where are we? Okay, so AGI, which stands for what again? Yep, adjusted gross income is 87,228. And I think did I tell you what standard deduction to use?
Yeah.
12.2, right? But from here on in, I'm not going to give you any of the weird filing statuses. You need to know 12,200 for single, right? And 24.4 for married filing joint. Those numbers change every year by a couple $100, but we're dealing with 2019, right? Okay, so minus 12.2 was all more than 12,200, you would have that. But we're not, that's kind of beyond our scope. Minus 12.2. This is the number that you take where? To the tax tables, right? That's my taxable income. And it says it, taxable income. And the slides we were just looking at said tax on taxable income, right? Okay, so any questions on anything on this first page? Pretty straightforward, right? If you had 5 W-2s, you'd just add them all together, right? What if you had a couple bucks from your savings account? Where would that go on this? What line? Just read it. $7 of interest on my Clearwater Credit Union savings account. Where does it go? 2B, taxable interest. That's really, in all honesty, what most of you will be seeing at this stage of the game. Okay, so then this number carries to the top of the second page, doesn't it? Always make sure, even though it doesn't ask for it, you need to re-enter. And obviously most of us are going to be doing this on software, but just to get in the habit. And by the way, why am I making you do this if most of us just plug the numbers into TurboTax or... Hey, you gotta have some way to check it. It's kind of a joke, but not really. Nothing makes me happier when somebody comes to me, a new client, and says, I've been using TurboTax, but something else has just happened and I want you to start taking my tax return. It always makes me excited because the odds of me having to amend a prior year are high. Because they don't know anything about tax law, so they're just putting stuff in. Like their rental interest ended up on their Schedule A. Well, that's the problem. So, not that it's not great for lots of people with really simple situations, but you have to know what the output's supposed to look like, right? Okay, so I'm calculating the tax on that prior number, right? 75,028. So I'm going to go look that up on my tax tables. And I'm over here because I'm single, right? So what does my algebraic formula look like? No. It doesn't look like 75,028 times 0.22. Why not? It's chunks, isn't it? So, Cammie, what does your formula look like? Yep. Go ahead.
What it,
39,475 minus 9701, that next chunk of 29,774. Is taxed at 12%. Right? Does everyone see where I got that number? So the first $9,700 is at 10%. And then you've got to find what is this? 9701. The difference between 9701 and 39,475 is that next chunk. And that's $29,774. And then the amount over that is taxed at 22%, right? The amount over 39,475. 39,475 minus taxable income is 75,028. Oh. $75,029,476. Is that at 22%? Do you see the progressive nature of this? Different chunks are taxed at progressively higher percentages. If you add up these three numbers, it better come to your taxable income. So let's do that. 9,700 plus 29,774 plus 35,552. 75,026. So I've got to add $1 to each of these. And again, much like in the other calculations we've been doing, I'm super forgiving on rounding. I mean, if you're within a couple bucks, who cares? $29,775 times.
this is your taxable income?
This is my TI, taxable income. So I'm figuring, so my taxable income is 95,028. My tax is this amount. Holy buckets, is that what I have to write a check for?
No.
Why not?
They'll really charge your tax.
Yes, I've been paying all year long on my W-2, haven't I, out of my paychecks? Okay, first off, let's just stop here and make sure everybody understands where these numbers come from. Please don't feel silly if you need to raise your hand and say explain. It's just the chunks off of that tax table, right? It's not going to look the same if you're married filing joint because there was a whole nother column. Okay, so does everybody concur that my tax is $12,365 and my TI was from the prior page? $12,365. Add Schedule 2, blah, blah, blah. I don't even know what Schedule 2 is, so I'm not going to worry about that. But I will just tell you that that's all stuff like self-employment tax or penalty because you took your retirement out before you were 59 and a half, or all the other things you can get dinged on. Okay. This is very, very simple, so I'm not going to have any of these things. Okay. I can tell with one quick glance if my client is going to be paying or getting a refund. What am I looking at? Go ahead. The W-2. So look at her W-2, enter how much income tax she had withheld, and then you get to make this phone call. This is another thing that happened. She didn't have an accountant, and she got a new job that added 30 grand a year to her income, and nobody bothered to tell her if she should change her W-4 from what she'd done in the prior job. And she is going to be a way unhappy camper. Because last year she got a couple grand back. Another benefit of having somebody to kind of guide you through this. I mean, my goal is to empower you all so you don't need to hire an accountant, but honestly, when you're kind of getting ramped up to do this kind of thing, it's not a bad idea to pay. So, question, do I put state income tax on this? No, that's a completely different tax return, right? So it's just her FIT. 6415. $12,365 minus 6415, $59.50. And again, let me just stop and flag a couple things. I'll talk about them in a second. Let's finish this. So, total payment $64.15. She owes a whopping $5,950. So two things is happening with Indigo. One is she's got a big ass tax bill. And the second is you're going to be telling her that her monthly take home this year is going down by about 6,000 divided by 12, about $500 a month. So she's got a double whammy. She owes a bunch of money and her take home pay is going down significantly. Okay. For most of us, we would do this on a piece of software, or Montana would also generate, and then how would we transmit our tax returns? We would e-file them. Okay. But if you still like to do it the old-fashioned way, you would staple your W-2 on the front, put a check. How are you going to pay the IRS if you e-file? Yeah, you're going to, it's unfortunately not a deposit, it's a withdrawal. So you go, you put your routing number in, your account number, and then the date of withdrawal. What's the very latest date you can pay them? April 15th. What actually is going to happen to her too, because can you see how far she's under by almost 100%? She's also going to have a penalty, is going to get kicked through on this tax return, probably about another $100, because she underpaid significantly during the year. It's not enough to just get even by April 15th. You've got to pay as you go.
So for someone who has like tipped income and often owes money, have I been paying penalties on it?
If you've been significantly underpaying during the year, yeah.
Like in Rhode Island, you make like $2.89 an hour.
Right.
So I always owe like $1,200 to $4,000 at the end of the year.
Oh my goodness, yeah. So anybody, based on what we talked about last week, what would you advise Alicia to do if she's a tipped employee that's been historically paying a couple grand a year in taxes?
Make quarterly payments.
Make quarterly estimated payments. Remember we learned about that last week, a 1040 ES. And the way that you fund that is every week you put your $180 into a separate savings account, and once a quarter you write the check, right? Then at the end of the year, you're even.
Like minimum wage in Missoula, like as a waitress, and you claim your tips at the end of the night. How does that exactly work then?
Exactly work as far as taxation.
So
can you advise Shiley? So she makes, in Montana we make minimum wage even though we're tipped, right? But then at the end of the night she cashes out, does her digital readout and she puts in, I made $196 of tips. Is that going to show up on her W-2? Huh?
You don't have to put the full amount.
Well, see, that's actually not a true statement. So she's saying we don't have to put the full amount. The employer will tell you you only have to put 8% of your gross on your OASDI and HI. So it's in his or her benefit for you to claim less because that's less tax out of pocket for them, A. B, the law says you have to report what? What you earned. And C, in this day and age where some 90-some% of restaurants, everybody, it's all based on a card, it's completely auditable. My guess is you make a whole bunch more than 8%, you're probably a great waitress. You probably make 18 or 20%. So it's
So does that
just...
mean I'll be paying in, probably? Or how does that?
Well, if you're only... I probably don't want to record this. You should just be reporting what you made.
Okay.
Later.
As long as you're getting a paycheck though, you are paying enough to cover your taxes.
Okay.
Because that's why like you'll make like $100 a week paycheck.
Yeah, and then
versus-
it's like
yeah.
super, yeah.
So as long as you're making a paycheck, you're covering your taxes
Okay.
for the stuff you claim.
As long as you're coming home with a net
Yeah,
paycheck.
yeah, exactly.
Which doesn't describe what happened to you in Rhode
Yeah,
Island
that's
because you were
different in Rhode
making
Island.
minimum tipped wage,
Yeah, yeah,
whereas
but
here we
here
made minimum wage.
Yeah.
Okay. Got it? So let me go back to the two things that might be, or three things on here that would be important to you potentially. One, which I've alluded to earlier, is this guy. What is that again? On 18C.
Tax rate for tuition.
American Opportunity Credit, right? Tuition, fees, books, course materials, all that's included. But you can't just take the number off of your printout because that might have things like your health insurance in there. Or what's other stuff that would be in there?
Your gym.
Your gym fee, your transportation, yeah, all that's not included. You've got to get down there and get your raw tuition, your fees, and then keep receipts for your books and any course supplies, right? So you tally all that up.
Is the transportation fee and the service fee and the facilities fee are all mandatory?
That's
fees
the
that
question
would
right there.
include-
Could you opt out or is it mandatory?
Most of them are mandatory.
I don't think we have many opt-out fees, couple. I know the sustainability fee is opt-out.
It's $5, yeah.
Try and get that passed through the legislature to make it a mandatory fee. I'm like, dude, really? It's $5, but okay, whatever.
But you can include the mandatory fees, shouldn't you?
Yes.
The mandatory, yeah.
The majority of the Board of Regents are climate change deniers, so try and get a sustainability fee through them. Okay, so that can be up to $2,500. Okay? It's, am I going to get this right? I don't want to pull this off the top of my head. I'm going to go, I think it's 100% of the first 2,000. How are we going to find this? I want to know exactly how to calculate it. IRS.gov, American Opportunity Tax Credit.
Did you also look at the form number?
I could, but I don't know that.
Okay, but.
Or do I?
And it's right there.
Oh, okay, it's right there, 8863. Okay, but I mean, like, I don't know a ton of the forms that I do every year just because there's so many of them and they make no sense. So before we launch into the whole thing, let's just see. Here we go. Here's the $2,500 number. That's awesome. Oh, here it is right here. The amount of the credit is 100% of the first $2,000 of out-of-pocket expenses, plus 25% of the next $2,000. So it's up to $2,500. If you get it covered by like scholarships and grants, that's not going to work. But if you take out loans, you can use that. Okay. For your first 4 years, here's all the caveats. You've got to be pursuing a degree, enrolled at least half-time, only first 4 years, and you can't have a felony drug conviction. Go ahead.
What about something like a 529 fund, like an education fund?
Great question. So that's back to that premise, is you can never double dip in tax. So if you had something called a 529, which is a plan that you set up for your kids, or maybe a grandparent set up for you or whatever, and that's a tax deferred account like an IRA. If you take money out of that to pay for your tuition, can you use that then to claim a tax credit? Never. You can never double dip. If you've gotten a tax benefit on the dollar somewhere else, you can't take it and get another benefit down the road. Okay, and then what was the real kicker about this, so that I wanted you to remember? So say that you're somebody that's 20, your folks are helping you, you're working, everybody's trying to make this happen. Who gets the credit? Well, it depends, doesn't it? Huh?
It's your parents and then they hand the check to you, correct? Like after.
Right, but what's the magic question? Can they claim you as a dependent? And they can only claim you as a dependent if what? They provide more than 50% of your support. And that's everything. So if you put down on paper everything it costs to live, if your folks are doing more than 50% of that and you're under 24 and a full-time student, then they should be claiming you. And they get the credit, but they have to pay the tuition. If you're like a lot of kids this day and age, you know, I'm 21 and my folks are helping me paying like 30%, and I'm doing the other 70, I get the credit. That's the kid, the college kid. But if the part that my folks are doing is actually cutting the tuition check, that's going to really suck, because now nobody gets the credit. They should be writing me a check. Here's a gift, Lisa. And then I write a check to the University of Montana, and then I get the credit. Do you see what I'm saying? That's a really important thing to know, because I've had to tell people, like, wow, you guys just by transactionally not setting this up right just lost a $2,500 government credit. Okay. Other questions? And then once you're done with this, what can you take? What's the other educational credit once you've completed 4 years? Remember? Lifetime learning credit. And that you get your whole life. It doesn't matter. And you can have a felony drug conviction randomly, but you don't get books. And that's a lot less lucrative. It's 20%.
Same thing with the 529 though?
Same thing with the 529. That's just a standard tax theory. I can't ever double dip benefits. Okay, what time is it? 3:07. Wow. Okay. What is the scoop? Everybody's heard about this, right? Or no? The controversy around capital gains? Or nobody's heard about this? What's the controversy?
It's actually a lower rate of income.
Yeah, why? Well, first off, what is a capital gain?
You make an investment, and then that investment grows and gains.
Yeah. Like an investment in what?
And then stock.
Stock, piece of real estate, antique, gold, bonds, whatever. Doesn't matter. A horse, piece of livestock, a farm, doesn't matter. And it goes up and I sell it, I've got a capital gain. Okay? It's not going to work, it's not starting a business. Oh, what happened to my pen that I was using? Which, am I going the right way? There we go. I pay tax at one of these 3 rates on my capital gains. So if I'm down there in the regular brackets we just looked at, and I cap out at the 10 or 12%, I pay nothing. So think about that. I make 40 grand a year as a 2nd grade teacher, and see, that's a hard example because what would I be doing with lunch investments? I inherited a duplex from my grandma, a rental. And grandma bought the duplex in 1940 in Missoula for $5,000. And when she died, it was worth $350,000. And I sold it for $380,000. I only pay gain tax on that $30,000. But I don't pay any tax because I'm low income. Do you see what I'm saying? That's not as hard of an example for us to wrap our heads around as this person. I'm a real estate developer and I make $900,000 a year, okay, on commissions. So I've got to pay regular old tax on that. That's self-employment income, right? But also, what do I do on the side? Do I let my clients get a hold of the good houses to flip? No, I take them all. If I've got to hold on to them more than a year. But if they turn into long-term capital gains, I only have to pay 20% tax on that. You guys should be like, oh my God, that feels really unfair. Is that not, oh my God, feel really unfair?
We're taking risks.
Huh? Taking risk, being compensated for risk. Here's what came out like when Romney ran against Obama. That he released his tax returns back when candidates did that. And he had a $50 million of taxable income, and he paid less on that than his secretary because of capital gains.
Percentage-wise or total income, like total amount?
Is that the same when they like?
No, average rate. Average
Okay,
rate.
okay.
Average rate. He paid less average taxes on dollar of income than his secretary, who made like $129,000 a year. There's something inherently flawed with that. Most people see
Isn't the
that.
idea behind it to encourage investment?
It is, and there was, and if you believe in Keynesian economics and trickle down, that when a few wealthy people get wealthier, everybody benefits, then the system makes sense to you. And believe me, there's tons of economists that definitely believe that. It's not like there's one guy in the corner. The University of Chicago School of Economics framed that economic theory in the 50s, and lots of people believe it.
But hasn't it been being proven untrue, the gap?
How do you measure your variables? Do you pick and choose your data? Who do you listen to for your news, Lisa? You know, I mean, there's a whole slew of questions that answer that. Yes, I would say it's been disproven. Could I stand up against somebody from the University of Chicago with a PhD in econ and argue this? Probably not. Question?
So is that the same when people like buy, I think it was a mall that I was.
A mall?
Yeah, where they buy malls and then
Mhm.
hold them for a couple years and then just sell them outright right away. And then they just benefit off of that.
Sure, that's capital gains. That's capital gain. And the question is, really, I guess the question just for you to all think about, and I'm not going to give you an answer because I don't have one. Does that add value? Does that add economic value? Is that creating wealth or value, you know, for society? So that's your question to answer. Last thing. We've done itemized deductions. Okay, this is kind of an important takeaway as well. Credits and deductions are different, and lots of people use those terms interchangeably. Based on what we've just learned, what's different to you between a credit and a deduction without reading the slide?
Who gets them?
Certainly they're geared towards different people, yeah. A credit is a dollar for dollar reduction of your tax liability. $2,500 American Opportunity Tax Credit is worth $2,500. A deduction is only worth the amount times your tax rate, because it comes off of my taxable income and then I go to the tax tables. Does that make sense? I feel like I'm losing some of you today. I'm getting a lot of like So a tax credit is a dollar for dollar good thing. I get a $500 tax credit and I'm like, woohoo, $500 in my pocket. I get a $500 deduction and I'm in the $9,000 a year. That $500 reduces my taxable income and I save 10% of it, right? $500 times 10%. Because I'm in that lowest. Does that make sense? So it's only, a deduction is only worth the amount times your highest tax rate. Go ahead. Do you want to see an example?
No, I just have a question.
Okay.
So, if you get a $500 deduction, that means you don't pay $500?
It means you get to take that off of your TI, your taxable income. And when we got our TI, what was the next step? What did we do once we got our TI? We went to the tax tables. And then with X amount was taxed at 10%, X amount was taxed at 12%, X amount was taxed at 22%. So my TI went down by $500. That means that $500 was saved me $500 times my highest percentage, which in the last person's case was 22%. Right? Because my TI was less when I went to the tables. Whereas a credit, I've already been to the tables. I've already calculated my tax, and that $500 comes right off the top. Which one's better? The credit.
So tax credit is come out after you pay the.
After you calculate the tax, it's a dollar for dollar reduction. Yeah, credits are amazing. Deductions are good, but credits are amazing. Okay. Let's do some homework for next Tuesday. So do that tax return I just handed out, please. Ella Berry. And that'll be homework for points on Tuesday. So now that we've done one, you should be able to do it. And let me see how far. So we don't have too many slides left. That's good. Let's do some homework out of the book as well, which is chapter 3. Okay, so number 1, number 2, 118. Number 4. And of course, all this is saying use 2014. Well, you're not. You're using all the data I've given you from 2019. Okay, because the book is that old. I love the book, it's just the taxes are dated. So number 1, number 2, and number 4, but obviously you're using the standard deduction for this year, you're using the tax tables for this year. And then Ella Berry.
And reflection.
And your reflection on your spending journal. Thank you. So let's put this all up there. Where am I? Spending journal, number 1, 2, and 4, and Ella Berry. You know what I'm going to make you do, just because you guys get out of an hour and a half of class this week, is I'm going to have you do her Montana tax return too. So I'm going to go grab that. Montana, and I'll put this taxes and fees. Where's my individual tax return? Individual tax return. And I will put, oh, here we go. Your individual tax return in Montana is called a Form 2. And I'm just going to put the URL for that right here underneath the Montana one. And you can do the exact same thing with Montana that you do here. Montana DOR Form 2 that you do with the feds, which is you use the instructions. Okay, so here's your Form 2. Same information.
For elementary.
Sorry? Go ahead. Okay.
What is it exactly that you want us to?
The tax return.
No, the spending.
Oh, the spending journals is what we just went over at the beginning of class where I brought up the assignment from the first unit.
Okay.
So categorize them, do the percentages, and then what were the questions I asked? Stream of consciousness on like, how did I do? How would this impact my budget? Would it change your cash flow budget? If so, how? Blah, blah, blah. If you have any questions on the numbers, because I felt like a couple of these looked a little puzzling, you need to ask me, because this doesn't really go away the whole filing process. Okay, Alicia, whenever you are ready, doll.